When a structural load exceeds its carrying capacity, the failure is violent and immediate. Financial systems operate under the exact same laws of physics. The early credit default swap, or CDS, market was built with a critical mechanical flaw. A CDS is a financial derivative that acts like an insurance policy against a company defaulting on its debt. Originally, these contracts required physical settlement. If a company defaulted, the buyer had to physically acquire the defaulted bonds and deliver them to get their payout. This worked until the total face value of the derivative contracts grew vastly larger than the actual debt issued by the underlying companies. The breaking point arrived with the 2005 Delphi bankruptcy. At the time of default, investors held an estimated $20 billion in CDS contracts tied to Delphi. However, there were only $2 billion of actual Delphi bonds in existence. This 10-to-1 imbalance engineered a massive short squeeze. Investors who bought CDS protection were suddenly forced into the open market, desperately trying to source physical bonds that simply did not exist. The math was inescapable. Without a systemic intervention to bypass the delivery bottleneck, the multi-trillion-dollar credit derivatives market faced immediate collapse. The solution was a highly controlled two-stage auction designed by Market and ISDA. ISDA is the International Swaps and Derivatives Association, a trade organization that sets market standards. Their protocol forced a transition from physical delivery to cash settlement, allowing contracts to be paid out based on a mathematically derived market price. The algorithm had to achieve two conflicting objectives simultaneously. It needed to find a definitive clearing price for highly illiquid distressed debt, while employing strict game theory constraints to prevent massive market participants from manipulating the final payout. To test if this mathematical fix actually works, we rely on a dataset of 23 major corporate defaults from 2008 and 2009, including the collapse of Lehman Brothers, the bankruptcy of General Motors, and the CIT Group. We will cross-reference internal auction data with public bond trading records from the days surrounding these bankruptcies. We are going to reverse engineer the rigid math of the ISDA auction and then analyze the trading data to determine if this algorithmic pricing stabilizes distressed markets or simply distorts them. Phase 1 of the auction begins with data collection. Participating dealers aggregate physical settlement requests, or PSRs, from their clients. A PSR is a binding request from a CDS investor to buy or sell a specific face value of the defaulted bonds at whatever the final auction price turns out to be. The first anti-manipulation rule restricts these requests. Clients are strictly capped at submitting PSRs that match their actual market positions. This ensures a participant cannot synthetically inflate demand or supply simply to skew the auction's trajectory. Once verified, administrators tally every single buy and sell order. The resulting number is the net open interest. This represents the exact singular imbalance of bonds that the auction must ultimately clear. Alongside the PSRs, participating dealers must also submit initial market submissions. These are blind, two-way quotes, meaning both bids and offers, based on a standard trade amount designated by ISDA. To ensure honesty, ISDA enforces an adjustment amount penalty. If a dealer submits bids or offers that are deemed wildly off-market compared to the consensus of the other banks, they are hit with hard financial fines. Phase 1 forces highly incentivized dealers to reveal their true baseline pricing. By punishing bad faith quotes with immediate financial penalties, the algorithm extracts clean data from a chaotic market. We can observe how this data is sorted mechanically by looking at the CIT Group auction. The system takes the Phase 1 submissions to calculate the initial market midpoint, or IMM. The IMM is a benchmark price derived purely from the dealer quotes. This diagram shows two distinct columns of numerical data representing the raw dealer order book. The algorithm sorts all submitted bids in descending order on the left and all offers in ascending order on the right. Next, the system strips away overlapping data. It identifies any rows where a dealer's bid equals or exceeds an offer. These are classified as tradable markets and are completely removed from the calculation. The algorithm isolates the remaining non-tradable quotes. It then brackets exactly the top 50% of these pairs, creating a dataset designated strictly as the best half. Finally, the system calculates the arithmetic average of this best half, rounding to the nearest standard fraction. For CIT Group, this locked in an IMM of 70.25. The IMM is not the final payout price. It is a mathematically purified baseline, cleansed of extreme outliers and artificial spreads. It exists to serve as the ultimate safeguard in the second and final phase of the auction. As the auction moves into Phase 2, the dealer's initial market submissions automatically carry over and convert into actual binding limit orders. This is where the market is most vulnerable. A net short CDS whale could theoretically submit a massively inflated limit order to buy up the entire net open interest. By artificially pumping the final bond price, they would successfully suppress the cash payout they owe on their derivative contracts. This diagram displays how the algorithm prevents that exploit. The horizontal baseline represents the IMM. ISDA mandates a hard ceiling, capping the final auction price at the IMM plus exactly 1/2 of the standard bid-offer spread. Any aggressive, inflated limit order simply deflects off this mathematical ceiling. With the cap in place, the system executes a Dutch auction. It matches limit orders against the net open interest until the imbalance is completely filled. The price of the very last order required to fill that demand becomes the universal clearing price for every single participant. This two-stage structure utilizes game theory, financial penalties, and mathematical boundaries to trap manipulators. The output is a highly defensible, universally accepted cash settlement price. We can prove to theory by analyzing the empirical reality. We turn to trace data, the regulatory system that publicly reports over-the-counter bond trades. By tracking actual transactions 5 days before and 5 days after these 23 corporate auctions, we can measure the algorithm's actual impact. The data proves the necessity of the auction because the pre-auction market completely fails at price discovery. A linear regression of the data shows that pre-auction trading levels have incredibly weak correlation to the actual value of the bonds, offering almost zero predictive value for the final clearing price. Conversely, the post-auction data validates the algorithm. A second regression analysis confirms that the auction's final clearing price is a statistically significant predictor of where post-auction bond prices actually settle. The ISDA mechanism achieves its primary goal. It forces true price discovery into an opaque, distressed market, providing an accurate valuation that standalone trading entirely failed to produce. However, the data reveals a counterintuitive anomaly. According to standard market theory, if an auction successfully solves price discovery, market uncertainty should drop, driving post-auction volatility down. This table shows the exact opposite. Across the 23 entities, post-auction price variance actually increases. 14 of the 23 reference entities display higher volatility after the definitive price is set. This precise volatility spike perfectly correlates with a massive, simultaneous surge in post-auction trading volume. This behavior points to the sidelined capital hypothesis. Before the auction, the market is distorted by CDS investors whose positions are perfectly hedged. Because their derivative payouts offset their bond losses, they're indifferent to the actual trading price. They simply want the settlement finished. Recognizing this distortion, true distressed debt investors wait entirely on the sidelines. They refuse to step into the illiquid market until the derivative overhang is officially cleared by the settlement mechanism. The auction clears the information logjam. Once the price is set, sidelined capital finally floods the thinly traded bond market. Paradoxically, this causes the exact volume-driven volatility the system sought to tame. The ISDA auction is a dual-edged mechanism. It perfectly resolves the derivative settlement bottleneck, but artificially delays the natural timeline of the underlying debt market. It is a mathematical triumph that prevents systemic financial collapse, yet the data clearly shows it merely delays rather than eliminates the inevitable volatility of distressed debt.